Alright, Unit 1, Introduction to Insurance. Cram sheet. Insurance transfer of risk from a person or business to an insurer. Risk, uncertainty, possibility of loss. Types of risk. Speculative risk, chance of loss or gain, not insurable. Pure risk, chance of loss, only insurance companies will insure. Exposure, possibility that a loss will occur. Example, auto accident, luggage loss on a trip, pet biting a mailman, employee hurt on the job, house fire, peril, a cause of loss, house burns down, peril is fire. Direct, physical loss, indirect consequence of a direct loss. Hazard, increase the chance of loss, physical hazard. The hazard can be seen, moral hazard. Dishonesty, moral hazard. Carelessness, star. Methods for handling risks. Sharing, transfer, avoidance, retention, reduction, star. Sharing, transfer, avoidance, retention, reduction, star. Contract policy, an agreement between the insured and the insurer. First party, insured customer. Second party, insurer, insurance company. Law of large numbers. The larger the group, the more accurately future losses can be predicted. Can-ham, element of an insurable risk. Calculable, affordable, non-catastrophic, homogeneous, accidental, measurable. Can-ham, calculable, affordable, non-catastrophic, homogeneous, accidental, measurable. Adverse selection, risks that have a greater than average chance of loss, not wanted by the insurer. Tendency for high-risk individuals to get and keep insurance. Why insurers go through the underwriting process. High risk, higher rate of refusal to insure. Reinsurance, an insurance company, the ceded company, paying other insurance companies, reinsurer, to take some of the company's risk. Reinsurers help spread the insurer's risk. Facultative, the reinsurer evaluates each risk before allowing the transfer. Treaty, the reinsurer accepts the transfer according to an agreement called a treaty. Stock insurers, owned by stockholders, divide dividends not guaranteed. Dividends is paid to the stockholders. Dividends is taxable to the stockholders. Issues non-participating policies. Mutual insurer, owned by the policyholders, the customers. Dividends is not guaranteed. Dividends is paid to the policyholder. Dividends is not taxable. Considered refunds of premium. Issues participating policies. Fraternal insurers, provides insurance and other benefits. Must be a member of the society to get the benefit. Reciprocal insurers, unincorporated. Members are required to pay an excess amount to the loss of any member of the group occurs, managed by an attorney in fact. Lloyd's Association, insurance provided by individual underwriters, not companies. Insurers, uninsured risk, hole-in-one contests, athletes' arms, celebrities' hair, Risk retention group. Liability insurance. Companies created for policyholders from the same industry. For example, a car dealer's risk retention group in which one car dealer can be a policyholder. Risk purchase group. A group of businesses from the same industry joining it together to buy liability insurance from an insurance company. The risk purchasers group is not the insurance company. Self-insurance, a business that pays its own claims, reserves funds to cover loss, retains risks rather than transfers. Federal government provides residual market insurance, insurance from the state or federal government, war risk insurance, nuclear energy insurance, flood insurance, federal crop insurance, unemployment insurance at state level, workers' compensation at state level, insurance company location, domestic, the state where a company is incorporated, foreign, company is incorporated in another state or U.S. territory, alien, company is incorporated in another country, certificate of authority, state license for an insured company, admitted or authorized, state requires the insurance company to have a certificate of authority, non-admitted or unauthorized, the insurance company not required to have a certificate of authority from the state. Surplus lines, insurance sold by unauthorized, non-admitted insurers. If one state's approved list of surplus insurers can only be sold to certain high-risk insured, cannot be sold solely for cheaper rates than licensed admitted insurers. Financial strength rating, a report card of the company. Methods of marketing, independent, exclusive or captive, general agent or managerial general agent, direct writing companies, direct response, no agent, producers involved, direct mail, magazines, televisions, internet, radio, television, advertisements. Agency, the insurance agent acts on behalf of the principal, insurance company. Agent's authority, express. What the agent's written contract with the company says, implied. Not written, activities that agent normally do to sell insurance, apparent. Activities an agent does that is a reasonable person would assume as authority based on the agent's actions and statements. Fiduciary trust promptly sends premiums to insurers, has knowledge of products, complies with the laws and regulations, does not commingle funds. In order to measure our success, we recommend that you answer a few questions like this. What are the contracts or devices for transferring risk from a person, business, or organization to an insurance company? What is a contract or device for transferring risk? Insurance. What is the following? Which of the following represents a pure risk? A poker game, gambling in the stock market, investing in a new business, the chance your house may burn down. The chance your house may burn down. Susan regularly leaves her side door unlocked when she leaves for work. One afternoon, a thief enters her apartment and stole all of her jewelry. What was the hazard in this example? The thief itself, the door being unlocked, the jewelry, the door being unlocked. It says, since Jeff lives in a good neighborhood across the street from the fire station. He decides to cancel his fire insurance policy. This is an example of which risk management method? Avoidance. Avoidance. Says sometimes an individual or business has an exceptionally large, specialized risk that no authorized insurer can or will cover. In this case, the individual or business may call a non-admitted insurance company. A. Insurance companies often purchase insurance to cover their own exposure to loss. This is called insurance companies often purchase insurance to cover their own exposure to loss. This is called reinsurance. Reinsurance, which is not an element of an insurable risk. Which is not an element of an insurable risk. Catastrophic, affordable, accidental, measurable. Catastrophic. Non-catastrophic is a person in a position of financial trust is called a fiduciary. The authority made explicit in a producer's agent written agency agreement with the insurer is the authority made explicit in a producer's written agency agreement with the insurer is expressed authority, implied authority, apparent authority, agent authority. Expressed authority, agent authority, expressed authority. The ABC Insurance Company is incorporated in Mexico while doing business in Texas. It is an foreign insurer. Alien insurer. Domestic, the same state. Foreign, another state. Alien, outside the country. This is KING-KAMBUF, bringing you nothing but the truth. 100 proof.